Do you want to kick off, Srini?
Yeah, I can do that. Hello everyone and good evening. Welcome to eClerx's earnings call for Q2 FY23. The performance in this quarter was robust. So revenues came in at $82.5 million, which is up 3.7% quarter on quarter and 4.6% in constant currency terms. Total revenues for the quarter were rupees 6,712 million, up 4.9% quarter on quarter. Due to the strong revenue growth as well as operating efficiencies that we were able to generate, and also helped by the depreciating rupee, margin performance was stronger with EBITDA of 2,023 million at a margin of 30.1%, which is up 8.8% quarter on quarter. Net profit was 1,259 million at 18.8% margin. The board has approved a share buyback of up to 300 crores through the tender offer route at a maximum price of 1,900 rupees per share. This will be put up for shareholder approvals shortly. Do note that our payout to shareholders remains consistently high as per our stated policy. So from FY18 to FY22, we've paid out approximately 70% of net profit and 70% of approximately of free cash flow to shareholders, including taxes. In Q2, we also paid out a dividend of 1 rupee per share. We also completed the process of issuance of bonus shares. The indicators on the key metrics slide are largely stable. We do want to call out one important metric. The number of clients in the $1 to $3 million bucket has moved up from 22 to 27, which I think is reflective of our ability to deepen relationships and grow with our clients. Headcount in Q2 was slightly higher than Q1. This is because of two factors. One is lesser hiring in Q2, and the second is something that I alluded to in the Q1 call itself. We were carrying excess bench in Q1, which now got converted into billable staff. Attrition moved up by 8 percentage points from Q1 to Q2, which is slightly lower than the 10% increase in the same period last year. We do see attrition easing. We see number of resignations going down in Q3, and we believe that the peak is behind us. Given the uncertainties in the global macro environment, we expect to get better visibility into calendar 2023 outlook in the next quarter or two. On margins, we continue to believe that our goal of 28 to 32% remains appropriate. As always, thank you for your support and belief in us. We can now move to the Q&A. Jatin, has Asha been able to join, and will she moderate this Q&A?
So she is still trying to join. She is not able to join us.
Okay, then I can probably moderate it. So anybody with questions, you may please raise your hands, and then we'll go into the Q&A. So the first question is from Ruchita. Ruchita, please go ahead.
Hi, am I audible?
Yes.
Yeah, so I had a couple of questions. So the first one is regarding the growth outlook for our top clients. If I were to see the growth in the past 2 quarters seems to have primarily been led by our top 10 clients. So just wanted to understand what kind of growth momentum do we expect in these clients going forward, and if there are any sort of signs of weaknesses considering the macro environment. Also, in extension of that, our emerging clients don't seem to be growing at the same pace as our top 10 clients. So just wanted to understand how should one read this. Does this indicate any sort of signs of a slower decision making or a potential slowdown? And the second question pertains to the BPaaS revenue. Growth seems to have remained muted for the past 2 quarters. So just wanted to understand the reason for the same. That'll be all from my side. Thank you.
Ili, do you want to take that?
Yeah, I can take the first one, and perhaps Srini, you can take the second one. So in terms of growth, composition across clients, if you look at the revenue mix slide in the deck, you'll see our top 10 have been growing at about 20% year-over-year for the last 2 or 3 quarters. But our emerging clients, the $500,000 plus segment, has actually been growing closer to 30% if you take an average of the last 3 quarters. So I do think that, overall sort of the goal of the company, which is to grow emerging faster than the top 10 and therefore create less concentration, that is broadly working. And the other data point to that, I think, if you go back and look at the metric slide and the number of $1 million plus clients, today, we have about, as of last quarter, 43 clients that are $1 million plus. And if you looked at that same number a year ago, that number was only 36. So I think both those are reasonable indicators that growth has been broad-based. And, our client concentration, we do think, will come down. Having said that, it's great for us that the top 10 are also growing at 20%. They still continue to be a large chunk of our revenue base. So if you don't see growth there, that would have had an adverse effect on overall firm growth rate. So we are very happy to see growth in the top 10, but it's good to see that growth outside the top 10 has also been strong. Srini, you can talk about BPaaS, please.
Right. So I think when you look at BPaaS revenues, instead of looking at it Q on Q, there is usually not much variation from one quarter to another. It may be more helpful to look at a longer term view and look at year-on-year performance. And you will see that it has actually increased. That is one. The second is that usually a lot of the BPaaS revenue for us kicks in quarter 3 and quarter 4 because of pending work that our clients have, which are based on transactions and unit price. So you will see that quarter 4 usually is the highest in terms of BPaaS revenue. Note that excluding FY21 quarter 4, because there was personnel revenue addition in that quarter, which was all 100% FD. So that sort of brought the number down. But otherwise, I think long term you will see this metric up, and it's kind of difficult to move the metric in very sharp terms because it requires having a conversation with clients and getting them and convincing them to move from FT based pricing, which is what they are used to, into managed service kind of pricing. So it will take time to move up, but that is what our goal is. Ruchita, any other questions from your side?
Yeah, thank you so much. Just wanted to follow up. We do not see any sort of weakness in our top clients, do we? Like, what is our outlook going forward for the top clients?
Anjan, do you want to take that?
It's a hard one, but I think if you look at, I'd say we look at 2 metrics. One is internally we look at pipeline, and I guess we look at conversion rates. And I'd say pipeline continues to be pretty strong, but conversion rates are definitely slowed. So if that's an indication of a slowdown, then I would take it as one. So certainly, while people want to spend, there's a slowdown at which they're making decisions, and that's been noticeable. The second part of it, obviously, is uncertainty at our clients, right? So you'll see as many of our customers, many of whom make up, the global indices, are facing their own headwinds. So many of these guys are reducing headcount, they're reducing spend. So we would expect in the medium term that to have an impact on the IT and the BPO industry, but it's unquantifiable at this stage.
All right, that was very helpful. Thank you.
The next question from Manik Taneja. Manik, please go ahead.
Hey, hi, good evening. Am I audible?
Yes.
Yeah. So I had a couple of questions. Really, like you mentioned about the aspect that you've done very well in terms of the number of $1 million plus customers, increase in terms of customers at the lower end. When I look at our client metrics, it appears that we might be doing well with our top customers, as well as probably adding customers at the lower end. But the migration of some of these customers to higher revenue buckets, usually that is something that still remains slow. So would that be a fair reading? That's question number 1. And the second question was to essentially get a sense of what you are seeing across the three parts of our business in terms of financial services, customer care, and the segment. If you could help us understand that. Thank you.
Hi, Manik. Thanks for your question. So I'll take the first one and I'll request Anjan to respond to the second one on segment-wise outlook. So I think, broadly speaking, you're right that the larger the revenue threshold you apply, the harder it is for us to consistently migrate people up into those tiers. So for example, it's much easier for us to migrate a client from 500K to $1 million than it is to migrate a client from 1 to 3 or 3 to 5. And there will be a drop off, right? So in terms of percentage of clients in any given tier whom we are able to successfully migrate up to the next threshold, there will be a drop off. Having said that, I think even if you look at sort of the larger clients, the $3 million plus clients, we have seen an increase from 12 to 16 over an 8-quarter period. So over 2 years, we've seen a 33% increase in that cohort. And obviously, if you look at the $1 to $3 million clients, I mean, there's been a much larger increase there from 16 to 27 over that same 2-year period of time. So I think you're right. Creating $10 million clients for us is a difficult event for us, and it's not a very common event, but it does happen. But hopefully, if we can create lots of $2 million, $3 million, $5 million clients, that will help us maintain the momentum. And I'll hand over to Anjan to respond to the second part of the question.
So Manik, I feel like that's sort of the broad strategy of specialization, product investment, combination of onshore and offshore has continued to play out for us, which means that demand in the pools that we play in has continued to be strong. So I think there was an observation made earlier about, slowdown in emerging clients. But I think certainly because, a lot of our growth continues to come from existing clients, as you know. That pool of demand we've seen to be strong. I think, as I've said, there's been some slowdown because of uncertainty at the edges, but we still seem to be growing relatively quickly, and there seems to be a fair amount of demand for the book of work, at least that we service. And I would say that that's consistent across the 2 big books in markets, which is sort of client lifecycle and trade lifecycle, and the 2 big books in customer ops, focused on care and engineering services, and broadly around the high level 3 books that we have in digital, which is focused on content, marketing, automation, and analytics. And I think the one other thing I'd say that's helped us in the last year and a half is sort of this pivot towards automation and analytics, where we're beginning to sort of win more work on the periphery of those big product areas, where guys are hiring us to do sort of what we've called subject matter expertise related automation and analytics. So I think all in all, we feel, I would say, relatively sanguine, but obviously, if you start seeing clients disappear or, entire markets sort of shut down, then I think it'll be a different game. But we can't predict that macro level event.
Manik, any follow-up question?
Yeah, so the other thing that I wanted to get your thoughts on is the fact that, like you alluded to in your opening remarks, that we paid more than, so while our historical policy has been to pay 50% of our earnings as in the form of dividend/buyback, but over FY18 to 22, that payback, that return to shareholders has been much higher. So should we assume that as the new normal in terms of our policy, in terms of returning cash to shareholders?
Srini, should I take that?
Yes, please.
So Manik, we say 50% as a target. One thing to keep in mind is the other competing application of cash could be acquisitions. So to some degree, where we end up in terms of payout ratios is also a function of acquisition opportunities that we see and we are able to close on. So over the 5-year period that Srini did the measurement for, we had one deal that we closed with Personae. And so therefore there was more cash available to return to shareholders. I think broadly speaking, we all feel that there is not much utility to accumulating large cash balances in the company, because given our conservative investment philosophy, return on cash, our treasury cash will be low, and I'm sure shareholders have a much higher opportunity cost of capital that they would target. So, we will keep some buffer for capex and, for opex and some for liquidity, but beyond that excess cash we'd want to return.
Thank you and all the best for the future.
Thanks.
Thanks, Mike. The next question is from Hitesh Arora. Hitesh, please go ahead.
Thanks. Congratulations on a good set of numbers. Just any visibility on the roll-offs, thus far, and any specific outlook for FY24 that you have, you can, throw a little more light on.
PD, I'll take care of this. So roll-offs this year has been lower than FY22, which itself was a low year of roll-offs for us. So I think we've been helped by that. I think in terms of the future, we don't see anything significant or material which is coming up. And I think that's it's been a positive situation as far as roll-offs are concerned.
And that visibility you would have, let's say, for the next 6 months or something, or more?
Well, usually it's about 2 to 3 months, and bear in mind that all our clients can cancel. Most of our clients can terminate contracts with 30 or 60 days of notice.
Okay. Fair enough. And we are presumably, given our run rate, we are still should be comfortable with the double-digit growth, I presume, for FY23 at least.
Yes.
Okay. Anything specific on the outlook from the clients that, from your conversations? I know you alluded to in the previous questions, but anything more specific that you can talk about what your clients are saying in terms of offshoring, the business, etc., to India, or in your other marketing verticals? Anything more that you can help us understand your business better would be very helpful.
PD, do you want to take that?
Actually, I think, Anjan, you might do a better job of responding to that in terms of general client environments and feedback.
So I think the demand for India continues to be pretty strong, where we have clients that already have very large GICs and already have very large exposure to India vendors. They are looking at second sites, but I would say in general, that's peripheral, and the demand for India is very strong. So I'd say I think that's certainly sort of the geopolitical risk, one, and two, India's performance during sort of the whole COVID stand down was very, very positively received. So I think broadly that's a very good positive for India-based work. I think anything beyond that, again, is client specific. We don't really share, and I think there's no specific trend to speak of, as opposed to the one that I just mentioned.
Okay, Hitesh, any follow-up question?
I'll come back in the queue.
All right, thank you. The next question from Sandeep Shah. Sandeep, please go ahead. And Asha, I'll hand over to you if you are online.
Yeah, thanks. Thanks for the opportunity. Can you hear me?
Yes.
Yeah, just a question in terms of recruitment. So this quarter is a soft recruitment where we have added 0.6% of the last quarter base. And generally, there has been a good correlation of your recruitment with the future quarters growth. So is it more to do in anticipation of some sluggishness of demand in the second half? Or is it more to expect that bench coming on a billable role and there could be a utilization improvement and the growth is unlikely to slow down from what we have seen on a Q-on-Q basis in the first half and second half?
I think largely it is the second. So we were carrying very high benches in Q1, both because attrition was high, plus we were expecting some work to get billed in Q2. And attrition has eased up significantly in the first couple of months of Q3. And we've been able to get our utilization up by getting some of the people on the benches billed. And that is why you don't see a as significant jump in the headcount numbers as we saw in Q1.
Okay. So this is helpful. And just to follow up, Srini, last time you said that the SEZ regulation in terms of working from home threshold from mid of October, which I believe got delayed. So in that scenario, is it fair to say now our expectation of 28 to 32% is reinstated versus earlier, because of which you were saying it could be 28-30% rather than 28 to 32%? And in terms of follow-up to earlier question, with expected higher utilization, is it fair to say with wage hikes also behind, margin may have an upside on a going forward basis rather than downside?
So the second question first. Yes, I guess so. High utilization should definitely help. Because the return to work norms have been relaxed and the government is not in any pressing hurry to ask people in SEZs to come back to work, I think that will also probably help our margins in some way.
I do want to add, one thing, Sandeep, is that if you look at our numbers, we have been beneficiaries of rupee depreciation in terms of revaluation income. So we've had between 15 and 18 crores of revaluation income both in Q2 and Q1. And obviously, nobody knows if that will continue or in what direction the rupee will go. So to some degree, all of these benefits that we've been talking about may potentially be required to fill the gap that goes away if the rupee depreciation stops, right? So that's why I think Srini made that comment in his opening remarks that range of 28 to 32 is appropriate.
Okay. And just last thing, in terms of what Mr. Anjan has said, some uncertainty in decision making and conversion of the deal pipeline being slightly slower. Do you believe that this may have an impact even in the second half? And secondly, what proportion of our portfolio or revenue which you can describe as a discretionary versus annuity, sticky or defensive portfolio?
Anjan, do you want to take that?
Yeah, I think I would say a very large percentage of our book of business is what I would call critical and critical services, which is what we've always maintained. And I think that is continuing. I think I had prefaced my previous comment by saying that the overall pipeline is bigger, but conversion rates are slower. So if you do the math, I guess on that, you'd expect almost, you shouldn't expect a slowdown on the basis of that. I was giving anecdotal color that decision-making cycles are definitely slower because people are waiting.
We may have lost Anjan temporarily, but, I just also, to supplement his remarks, I'll quantify this a little bit. If memory serves me correctly, if you look at last financial year, in terms of sequential growth rates, we were, usually 5% plus in almost all the quarters, right? Whereas if you look at this year in the 2 quarters so far, that number has been somewhere between 3 and 4%. So to some degree, there is already a reflection of slowdown as compared to last year. But I would also submit in the same breath that last year was an exceptional year for us and for the industry because, we grew 20% year over year. And many of our much larger peers also, had scorching growth rates. So undoubtedly, there is a slowdown from last year. Maybe things continue as they are, maybe slow down a little bit more. But regardless, I think at least for this year, to a question somebody else asked, we still anticipate a fairly decent year and certainly double-digit growth rates.
Okay. And just any quantification on a discretionary portfolio percentage as a percentage to total?
It's about 70% on discretionary and 30%.
So 30% is discretionary, 70% is annuity repeat business.
That's right.
Okay, thanks and all the best.
Thank you, Sandeep. Next question comes from the line of Ayush Rastogi. Ayush, I have unmuted you. Please go ahead. Ayush, you can speak. Ayush, are you there? Yeah. Ayush, your line is unmuted. Please go ahead. Maybe we can take next question. Next question comes from the line of Shraddha. Shraddha, your line is unmuted. Please go ahead.
Yeah, hi. Can you hear me?
Yeah.
Yeah. So just wanted to understand the demand trends in Europe, especially in the context of CLX Digital. Are we seeing anything particularly soft there compared to other segments or other geographies?
PD, would you like to take that?
Sure. So, I would sort of break up the CLX business into two parts. I think the part that faces the luxury brands, which is the majority of the book, we continue to see fairly strong demand. So there has been no slowdown there yet. There is a smaller part of the revenue that faces retailers and also, industrial clients. There we seem to have seen more of a slowdown. But, on a consolidated basis, we still expect CLX to grow this year compared to the last year. Of course, the last thing I'll say is, in reported terms, they will have a tougher year because the euro is depreciated, 15% against the dollar. So in reported dollar terms, the picture doesn't look as strong, but at least in native euro terms, we should see decent growth this year on the portfolio as a whole.
Got it. And sir, in the total headcount number, we've seen a good jump up in the tech services headcount number. So what does that relate to?
So there is some amount of investment that we've been making on the tech for the last, 6 to 9 months in productizing some of our services, making tool sets available for the chosen line of services. So that is one of them. And the second is that in general, our tech services have seen good pickup. So that is the second reason.
Got it. And just one clarification, what is the number between annuity and discretionary that you gave out to the last participant? I just missed out on that.
70% and 30%.
70% is annuity.
Non-discretionary, yes.
Okay, got it. Thank you.
Thank you, Shraddha. Next question comes from the line of Ayush. Ayush, please go ahead. Ayush, you can speak right now. Next question we'll take from the line of Samir Dosani. Samir, please go ahead. I have unmuted your line.
Yeah, thanks for the opportunity. I think on financial market side, right? So 2 parts of the business. One is trade cycle and client cycle. Can you just give an outlook because the capital markets has been very volatile, and if you can just throw some light, what's the outlook there in terms of overall segment?
Anjan?
I think it's been pretty bullish. It's been one of our fastest growing businesses over the last 3 years, and we haven't really seen any slowdown in that business. So both those areas, for example, the client lifecycle business tends to be driven by regulatory pressures and compliance pressures. That has only continued as there's been more government focus and more regulation put on banks and other financial institutions. And the trade lifecycle business, the area that we play in, which is the institutional part of the business, it continues to be a very volatile, and it's driven largely by volatility and complexity of businesses. And I think that's continued. So the clients that we work with, which tend to be the large global banks, they've seen their market share increase. And so as a result, we've seen our business increase. So both those demand books, we're seeing as healthy at the moment.
Okay. So, a few banks across the world have been facing issues in terms of, their mortgage businesses or some of them are also, having bankruptcy issues. So are there any clients that we deal with are at the risk of that? If you can speak about that. And also second part, client life cycle, whenever there are recessionary pressures, do you think there is some regulatory leeway available to the clients where they will say, let's do KYCs or, just updating databases, if we can delay it for 12 months? If you can just throw some light.
I can't, I mean, it's hard for me to answer what regulators think. But if you look at past history, I feel that regulators don't seem to really care much about recessions or growth. I think they care a lot about compliance. And I think and I think broadly there's a feeling that the banks have made a fair amount of money over the last decade, and compliance is number one. So we don't see a reducing overhead in compliance. We're only seeing an increasing one, and that's continuing. I think, the second part of the question, which I think you asked first, was do we have any clients that we see under financial duress? That's hard to say. I think certainly we don't have any clients in the banking space that are on the verge of bankruptcy, I'm very happy to say, which was more than we could have said in 2008. We do see some clients that may have to sell parts of the business, but that's the minority of our business. The majority of our business, I think, as I said, are the large global banks that are actually increasing market share in this marketplace. So, as I said, it's a wait and watch, but the immediate to medium term still looks pretty sanguine.
Understood. And the second question is around this, the BPO business or the customer care business that we do. So here, I think if you can just throw some light, what is the outlook? Because if you can just share overall color or what is the outlook here? Thanks.
You want me to take that, Srini, PD?
Yes, please.
So I think, if you were to ask anybody about the long-term prospects of the call center business, care business, we all know that voice is moving towards chat, or towards self-help and what we call omnichannel help, which is sort of SMS, text, web, etc. So, we and our businesses, I would say, well poised, because that's sort of the transition that we've been really helping our clients make. Because our first foray into the space when we started almost 6 or 7 years ago was in that chat, what we call the intelligent chat space. And that's a growing part of the business for our.
Samir, is that
part of it is that I think we're probably seeing that a lot of people that had left India in the care business, sort of in the first part of the 2000s, are sort of reassessing India, given sort of, I guess, broadly improvements in communication capability in terms of technology and in terms of skills. So I think there
is some.
Can you hear me? I think I fell off right there.
No, your line was lost.
Now we can hear you.
Yeah.
Asha, are you able to hear me?
Yes, now. Please go ahead, Anjan. I think we are not able to hear you, Anjan, now.
PD, do you want to take that question? Because I think my internet is I don't know what's going on, but I'm sort of losing this access.
Yeah, sorry. So the question was about broad demand on the customer care side, right? Yeah. So, to the point that Anjan was making, at least in the near to medium term, we continue to see reasonably good demand, especially for the kind of work we are doing, because we are not really doing a lot of level 1 work. Most of the work we are doing is either in chat or I would say level 2, level 3 kind of support for clients. And there's also some consulting work that we are doing with clients in terms of helping them improve the efficacy of their customer contact processes. And also in the last couple of years, if I look at actual growth, the business has performed fairly well. So long way of saying, at least I think in the medium term, in the short to medium term, we remain positive about prospects.
Understood. So, and lastly, if I can squeeze in. So, I'm not sure whether our business has impacts of furloughs, because IT services has this impact of furloughs because of lower working days. So do we also see that impact, and do you have some visibility on that? Because you would have 2 to 3 months of visibility, right? So you can just share the color on that.
So for us, it is much lower. So the operations part of business, there is no concept of furlough because it is lights on the business. And to the extent that we are doing IT support and staff augmentation kind of work within the IT services area, then there might be some impact of the furlough for those specific pieces of the work, but I think it is a very small portion of our
No, but our financial markets would deal with volumes, and volumes are generally lower in Q3. That would have an impact, right?
But that is not to do with IT, isn't it?
Okay. Okay. No. I mean, I'm saying overall financial markets as a segment, the volumes, the derivative volumes and everything would be lower. So that would have an impact, or?
No, that will not have an impact because clients pay us mostly in that world on an FTE basis.
Okay.
And they don't go up and down that dramatically.
Okay. Thanks. That's it.
Thank you, Samir. Next question comes from the line of Siddhant Maheshwari. Siddhant, I have unmuted your line. Please go ahead.
Yeah, hi. Am I audible?
Yeah.
Yeah. I have a small question. If I look at the utilization percentage, then except Q1 of FY23 and Q2, utilizations were quite high in the range of 78 to 80%. I'm talking about, let's say, last 6 quarters before FY23. So what is the reason for that? Is it you just said that since the constant currency growth rate has also come down. So whether these two things are connected or anything else?
So it is not related to currency, but it is related to the amount of bench that we are carrying and the amount of attrition that we are facing, and therefore we have to carry that excess bench. So in the last 3 or 4 quarters, our bench across the businesses has been pretty high. And it's only now that we are seeing attrition going down a bit, and therefore I expect that the utilization should improve in the next 1 or 2 quarters. Do bear in mind that it takes some time for the utilization to pick up as people are more confident that attrition is going down, therefore they don't need to carry some excess staff and so on. I think 80% is sort of unusual in the sense that it was probably a one-off. 77, 78 is probably the long-term average for us.
Okay. So thanks. So you are saying this is purely because of high attrition. Yeah. Thank you.
Siddhant, are you done?
Yeah. Thank you. I'm done.
Thank you, Siddhant. Next question comes from the line of Ruchi. Ruchi, please go ahead.
Thank you. I joined the conversation slightly late, so pardon me if it is a repeat. I can see the on-site revenue has declined here. So in a weak or challenging macro, typically consulting is what gets impacted. That's more discretionary in nature. Is that the reason for the on-site revenue decline, or there is some other explanation for this?
Well, there is actually no reason. The decline is very minimal, and I don't think we should be reading too much into it.
And Srini, could the CLX conversion into dollars be part of that? Does that get included in on-site revenue?
I will have to check. Maybe that is one reason. We can check that.
Yeah, we can check and come back to you, Ruchi.
Okay, thank you.
Thank you, Ruchi. Next question is a follow-up question from Sandeep Shah. Sandeep, please go ahead.
Yeah, hi. Thanks for the follow-up opportunity. Yes, I think in the initial remarks, we clearly said that CY23 IT budget clarity will come with the Q3 result. But any interaction with the clients gives you slight worry that CY23 could be a tough year versus CY22? Or you believe it could be other way where macro slowdown may lead to incremental outsourcing and offshoring, which even Mr. Anjan was saying that demand from India and offshoring from India has been becoming much in demand in the last 2-3 years.
You want me to take that, Srini?
Yes, please.
So, Sandeep, I think given a choice, we would always want clients to be having, enjoying sort of strong trading conditions as opposed to having, challenges in their business, because we feel, broadly speaking, that environment is more constructive for people like us than situations where, they're slashing budgets and so on and so forth. In terms of, I think it's hard to say, but given everything you read about the global economy, and you guys will know better than us on this front, it doesn't seem like 2023 is going to be stronger than 2022 from a macro perspective. So I think, if we are able to continue these, the growth rates that we are currently experiencing, the 3-4% quarterly growth rates that we've seen for the last couple of years, that would not be a bad outcome. But I think we'll get more clarity, as we said in the opening remarks, in the next quarter or two as to what the environment looks like. But in terms of aspirations, I think if we're able to match FY24 with what we'll do in FY23, that would be a good outcome.
Okay. And just PD follow-up, how to read this 30% discretionary portfolio in a challenging environment, which could be the case in CY23. So how the pattern for this portfolio in terms of revenue growth in the earlier years of slowdown?
So again, Sandeep, I think we have to look at it on a portfolio basis. So we have a portfolio where it's good to have some things that are defensive, some things that are more, if I can use that term, higher beta. And the combination of those two things, hopefully helps us deliver at least some kind of steady performance across cycles. So I don't think that I don't think we are uncomfortable about that mix in the portfolio. And all the remarks and the outlook that we are sharing with you is based on the specifics of our book.
Oh, this is helpful. Thanks and all the best.
Thank you, Sandeep. Participants, request you to please raise your hand to ask questions, if any. We have follow-on question with from the line of Samir Dosani. Samir, please go ahead.
Yeah, so just to
Samir, we are not able to hear you.
So a lot of these companies, can you hear me now?
Samir, please, now better. Can you please repeat your question?
Yeah, sure. So, a lot of these banks are putting, freezing on hirings, and they are also laying off people. So, I broadly understand there could be two things. One is that, they would, rather than firing people, they would rather insource the work and, make their resources utilized, or they would, since there is a hiring freeze, they would incrementally give more volumes to companies like you. So what is the kind of scenario that is playing on, you think, and which is the more beneficial scenario? So if you can just highlight that, yeah.
So I'll take that. So I think obviously it is more beneficial for us if the work does not get insourced. But I believe that there is a difference between the kind of work that we do versus what traditionally gets done by the captives. And clients tend to keep that in mind, because the profile and the skill set of the people that is required for each of these pieces of work is different. So insourcing is typically not as straightforward as saying that you want to pull work in because you don't want to fire your guys. What was the second part of your question, Samir?
So I was asking whether clients would would insource rather than firing people, or if there is a freeze, they would give more work to you. Is there any of the scenarios playing out?
Exist, but I think that if clients were to want to variabilize their costs, as I expect that they would want to do if they are under cost pressures, then they would prefer outsourcing, because that's the scenario where you can flex up and down more easily than you can do with your own staff.
In fact, Srini, can you hear me? Because I think that's a very good point.
We can.
I wanted to add one observation on this, that in the last 2 years, actually, we've seen a lot of roles move from GICs and captives to vendors, partly because a lot of captives felt that they weren't very resilient during the COVID period and in the period of high attrition. And I think in recent times, we've had more conversations with banks and actually non-banks, where, to Srini's point, they want to show reductions in overall FTE, because today the GICs and the India captives don't get treated like as a low-cost center. They're just treated as an FTE center. So when there's a push for reduction in headcount, the India centers get treated the same way. So actually, in an ironic way, that's an opportunity for vendor organizations, including ones like us. And actually, that can have a larger impact on discretionary spend, i.e. the part of our book that shows up as discretionary spend could actually flex upwards in times like this, because people are looking to variabilize their costs. Therefore, it's better for them to have those things done by third parties than have it done by themselves.
Okay. So, since you highlighted that a lot of the work has moved to, there's a portion of work that would have moved to us. So you can just quantify, right, what is the portion of work that you would be doing is still in-house or with the captives versus what you are doing for the client. If you can just, if there's something possible to, you can just.
There is no way to do that, because there's no way to do that, because it's not volume that is, it's functions that you split. So, we do different things for different organizations. So actually, that's a difficult exercise.
Okay, understood. And this would be more relevant in financial markets or the last segment, the customer case segment?
I think the financial markets tends to be the part of the industry that's the most, what I would call, outsourced, right? So they're the most mature buyers. The care business, by definition, is very, very vendor oriented. So there it's more a decision between vendors and a decision between locations versus doing it in-house versus outside, because very few people today would still want to run care centers in-house simply because of the cost advantage that third parties provide. And I think in the digital part of our business, it's really about skill. In many instances, the skill set just doesn't exist in-house. So a lot of that skill has to be brought in from the outside.
Okay. I was asking this, portion of work moving from captives to your organizations like yours. Which segment this has happened more? Is it the financial markets or the other two?
That tends to be across all three, but it's been most noticeable in the banks recently.
Okay. Understood. Yeah. Thanks. That's it from my side.
Thank you, Samir. Next question comes from the line of Sudarshan. Sudarshan, please go ahead.
Yeah. Hi, guys. I hope I'm audible.
Yeah.
Yeah, congrats on the extensive numbers. I just have a couple of questions. What will be the revenue mix from personnel during the quarter, and what will be your outlook on headcount addition going forward?
Do you want to take that?
Yeah, let me take the second one and you can take the first one. So, honestly, I think headcount addition, we don't have any target. It's a more dynamic thing, which is a function both of where we are in terms of benches and, what we see in terms of minute pipeline conversions. Because ultimately, I think our staffing model is fairly flexible and, it can respond reasonably quickly to changes in either direction. So even in our internal budgeting, we don't really set any headcount targets, and that is managed more dynamically through the year. In terms of where we sit right now, Srini had mentioned in response to an earlier question that we are at about 75% utilization. If you see longer term, we've been closer to the 78% kind of range. So clearly there is some room for us to float utilization up a little bit. So we don't need to hire as aggressively right now. But that's just a near term, outlook. Srini, over to you on personnel.
So on personnel, I think this quarter they have grown pretty much in line with the rest of the business. But in Q1, they had They had very, very strong growth. When we acquired them, they were about 10% of revenues, give or take. So that may have moved up slightly.
Darshan, is this your question is answered? Are you done with it?
Yes, Asha, thank you.
Thank you. Next question comes from the line of Darshan. Darshan, please go ahead.
Yeah. Hi. Can you hear me?
Yes. Yes.
Yeah. Thanks for the opportunity. First of all, congratulations for a good set of numbers. Sir, I had a question relating to your acquisition strategy. I mean, in the previous quarters, you had alluded to the fact that because of low interest rate regime, there was a lot of PE funds who were acquiring entities at much higher valuation multiples. Now that the scenario has reversed, are you seeing any possible acquisition opportunities in the coming quarters? I mean, do you think that the valuations have become more reasonable now and there are potential gaps that you can fill through acquisitions now?
Srini, why don't you take that?
Yeah. So we are looking at opportunities, and I think qualitatively speaking, we are probably seeing a little more opportunities than we used to see in the past. I'm not sure the valuations are at a level where it is still meaningful or interesting for us. I think we take quarter or two for that to come to levels which would be interesting for someone like us. But we are seeing more opportunities being sent our way.
And what would be the areas be in terms of opportunities? Which particular segments, which particular geographies are you seeing there?
Your question is which geographies are we seeing today?
Which geographies and which particular gaps that you feel you want to fill up possibly?
Okay, so in terms of if I look at our three businesses, then in financial markets, something on the buy side would be of interest to us. In digital, anything on analytics in areas that we don't service today, which is we do a lot of work in product marketing and operator intelligence. So anything that is around that or near that would be of interest. And in customer operations, something on providing care services to non-telco, that would be of interest to us.
Right. Secondly, in terms of the cable business in US, are you seeing any slowdown or are you seeing any revival? I mean, how is the current opportunity set over there? Because of late we have seen that a lot of the traditional media channels have adopted OTT in a big way. So how is it impacting our cable business?
Anjan, do you want to take that if your connection is still okay?
Yeah, I mean, I think cable cutting has been a trend over the last decade. So that's something that has continued. I think you've seen that as a result, most of our clients have moved on to streaming themselves as opposed to just being cable providers or connectivity providers. And we are certainly seeing a part of our business growing, providing servicing to the streamers directly. And of course, as I said, one part of our business is around engineering services. And obviously, if you're in the business of providing any kind of connectivity, you're also providing help desk support to those people that get that connectivity. So that's been an area of growth for us. So net, yeah, I think the business, our client base is mutating. They're moving towards a different set of services, including obviously providing, becoming owners and providers of content. But so far that demand hasn't, like the nature of demand has changed, but the demand has stayed or in fact increased.
Right. So net, it has been still a growth engine for you.
Yeah, because I think the industry is mutating, and we support the industry in aggregate.
Understood. Oh, okay. Thanks. Wish you all the best for future quarters.
Thank you, Darshan. Next, again, there is a follow-up question from the line of Sandeep Shah. Sandeep, please go ahead.
Yeah, just last bookkeeping question. Srini, if you look at the realized rupee dollar for us is slightly different than the average spot rate which we see for the others. So is it fair to say all the gains and losses on the matured hedges goes in the revenue line?
It will go into operating revenues, that is correct.
Okay. And how do you see, based on the hedge rate, going forward, will it improve in terms of gain in the revenue line, or do you believe it may have some more impact because rupee is depreciating as well?
I think there will be some, what is the rupee at currently 81.5, right? And our average hedge rate, if you can say, is for Q3 78.8. So I think that tells you what Q3 is likely to be in terms of gains or losses of the hedge.
Okay. Thank you.
Thank you, Sandeep. Next question is again a follow-up question from the line of Samir Dosani. Please go ahead, Samir.
Just a clarification. So this 20 to 32%, gains, margin rates that we are getting includes our other income, right?
Yes, our EBITDA calculation is based on total income, not operating.
And, just to understand, so if you can explain me, how does our ESOP policy work? Because we have a fund that buys. So if you can just explain how does the ESOP policy work overall?
Sure. So ESOPs are granted to staff in the top 1%, both India and outside. And ESOPs are granted at the money at the prevailing market price on the day we have the board meeting for the year. And there is a lock-in for 3 years. And after the 3-year period is over, the employees have another 3 years to exercise the options. Typically half of the ESOPs are time-based vesting, so the 3-year period is all that matters. And the remaining half is based on performance of the business.
So we don't.
Sorry to intervene, but I think we're almost out of time. So I would suggest that if you have a follow-up on the ESOPs, perhaps you can connect separately with me.
Sure. Okay. Thanks.
Thank you, everyone. As there are no further questions, we will now close the earnings call. I'll hand over back to the management for closing comment.
Thank you everyone for joining the call. I hope it was useful and informative, and we'll see you back in the next call. Thank you very much.
Thank you, everyone. Have a nice weekend. Thanks.